This Wednesday, the most powerful financial institution on the planet makes a decision that will affect your mortgage, your credit card bill, your car payment, and your paycheck. The Federal Reserve is meeting right now, and for the first time in a long time, nobody actually knows what comes next. The Fed has two jobs: control inflation, keep Americans employed. Right now, those two jobs are pulling in completely opposite directions. Inflation is still too high. The job market is softening. Oil just spiked 13% because of the U.S. Iran conflict. And on top of all of that, Jerome Powell is being replaced. A brand new Fed chair, handpicked by President Trump, is waiting in the wings. And the man tapped to take over has already called for a, and I'm quoting directly here, regime change at the Fed. So, what does this all mean for your money? That's exactly what we're breaking down today. If you're new here, welcome. We take the biggest stories in finance and translate them into plain English. Hit subscribe so you don't miss what's coming next, because right now there is a lot coming next. Let's start from the beginning, because I want you to actually understand this, not just nod along. The Federal Reserve is America's central bank. Think of it as the bank for banks. It doesn't give you a checking account, but it controls something more fundamental: the price of money itself. It does that through the federal funds rate, the interest rate banks charge each other for overnight loans. When that rate goes up, borrowing gets more expensive everywhere. Mortgages, car loans, credit cards, business loans, all of it rises. When it goes down, money gets cheaper. The economy speeds up. People spend and invest more freely. Right now, the rate sits at 3.5 to 3.75%. That's down from a peak above 5% in 2023. The Fed cut three times in late 2025 to support a softening job market. So why did they stop cutting? Because of what economists call the dual mandate. The Fed has two legal obligations: keep inflation near 2% and maintain maximum employment. Simple in theory. In 2026, almost impossible in practice. Inflation right now is running around 2.7%, above target. Job growth has slowed, and now oil is spiking from the Iran conflict, which could push inflation even higher. Cut rates to help workers, inflation gets worse. Hold steady to fight inflation, the job market suffers more. The Fed is stuck, genuinely stuck, and you are the one living with the consequences. There's a word that keeps coming up in financial circles right now, a word that most people under 50 have never lived through: stagflation. Stagflation is what happens when you get the worst of both worlds: a stagnant, slowing economy and rising prices at the same time. Normally, those two things don't happen together. Inflation usually comes from a hot, fast growing economy. Stagflation breaks that rule. The last time America experienced serious stagflation was the 1970s. An oil embargo sent energy prices through the roof. Unemployment soared. Inflation hit double digits. It was an economic disaster. To kill that inflation, Fed Chair Paul Volcker had to raise interest rates to 20%. 20. Mortgages were unaffordable. Businesses failed. It caused one of the deepest recessions since the Great Depression. Are we there in 2026? No, not even close. But traders and economists are watching the early warning signs: sticky inflation, slowing growth, oil prices spiking from a geopolitical conflict. Sound familiar? One EY economist this week described the risk as higher energy prices, tighter financial conditions, and renewed supply chain stress all hitting at once. That's a lot of pressure on an already strained economy. This is why Wednesday's Fed meeting is so important. Not because they're going to do anything dramatic, but because of what they signal about where things are heading. Every word Powell says on Wednesday will move markets. Okay, the Fed is stuck between inflation and employment. That's complicated enough, but there's another layer to this story that most financial coverage completely buries. Jerome Powell, the man who guided the Fed through a pandemic, a historic inflation surge, and back to relative stability, is leaving. His term as chair expires May 15th. President Trump nominated Kevin Warsh to replace him. Warsh is 55 years old, former Fed governor, Wall Street veteran, the youngest person ever appointed to the Fed board when George W. Bush tapped him in 2006 at age 35. Here's what makes this complicated. Warsh has spent most of his career as what Wall Street calls a hawk, someone who favors higher interest rates to keep inflation in check. That is the exact opposite of what Trump has been demanding. Trump has called for rates as low as 1%. He's posted publicly criticizing Powell dozens of times, and yet his handpicked replacement has a long record of supporting tighter money policy. Now, Warsh has softened his tone in recent months, saying the current Fed has been too slow to cut. But the question hanging over Wall Street is, will he protect Fed independence from political pressure, or will he bend to the White House? And here's the part that sounds like it belongs in a political thriller. Warsh hasn't even been confirmed yet. His Senate nomination is held up because of an ongoing federal criminal investigation into Jerome Powell himself. I'm not making this up. Senator Tom Tillis is blocking the confirmation hearings until that investigation is resolved. His reasoning? This is a bedrock principle of Federal Reserve independence. So let's recap the situation. Outgoing chair under criminal investigation. Incoming nominee confirmation stalled in the Senate. A war driving oil prices up. Stagflation fears rising. And the Fed meeting this week. This is genuinely one of the most complicated and consequential moments in Fed history in a generation. And it matters because every move the Fed makes or refuses to make arrives in your bank account. Let me break this down across 5 areas of your financial life, because this isn't abstract. This lands somewhere real. First, your mortgage. If you're buying a home or have an adjustable rate, rates are not coming down fast in 2026. Most analysts now expect only one cut this year, if any. If you're already locked in below 4%, that's one of the most valuable financial positions you can hold right now. Don't give it up lightly. Second, credit cards. The average credit card rate is still above 20%. Fed cuts eventually bring that down, but slowly and partially. Paying off high-interest credit card debt aggressively right now is one of the highest return moves available to almost anyone. Better than most investments, risk-free. Third, your savings. Here's the genuine silver lining that most people are sleeping on. High-yield savings accounts are still paying 4 to 5% annually. That is real, risk-free return that didn't exist 3 years ago. If you have cash sitting in a traditional checking account earning 0, you are leaving real money on the table every single month. Fourth, your investments. Higher for longer rates change the math on growth stocks and tech. Those big valuations depend on cheap money. In a high-rate environment, dividend stocks, value stocks, and energy stocks tend to be more resilient. I'm not saying sell your index fund. I'm saying understand why your portfolio moves the way it does. Fifth, everyday costs. This is the most felt and least discussed. If oil stays elevated and the Fed can't cut, your gas, groceries, utilities, all of it stays higher for longer. This is the silent squeeze on working families that never makes the headline, but shows up in the budget every single week. The Fed announces Wednesday, March 18th. No rate change expected. But here are the 3 things I'm watching that will actually tell us what 2026 looks like. 1. Does the dot plot show fewer expected rate cuts than December? The dot plot is the Fed's own forecast of where rates are going. If those projections shift hawkish, fewer cuts, higher for longer, expect bond yields to move up and growth stocks to pull back. 2. Does Powell address the Iran conflict and oil prices? If he signals that energy inflation could keep the Fed on hold longer, that's the market's cue to reprice everything from mortgages to tech valuations. 3. What does Powell say about his own departure? This is his last major press conference as chair. Does he use it to shape his legacy? Does he send any signals about Fed independence? Watch closely. Sometimes the most important words are between the lines. Let's land the plane. The Fed is caught between inflation and a slowing economy. Stagflation is a real risk. Not a certainty, but a genuine concern. Powell is leaving under extraordinary circumstances. Kevin Warsh is waiting in the wings with questions about independence hanging over him. And all of it feeds into your mortgage, your credit card rate, your savings account, and your grocery bill. Here's the takeaway I want you to leave with. The Federal Reserve is not something that only matters to Wall Street. It is the single most powerful institution shaping the cost of your daily life. Understanding how it works gives you a real edge, not just financially, but in how you think about the world. Next week, we're covering the student loan wage garnishment crisis. Over 5 million Americans are having up to 15% of their paychecks seized right now, and most of them didn't see it coming. That video could directly affect you or someone you love. If this video was worth your time, hit like. It genuinely helps this channel find more people who need this information. Subscribe if you haven't. And tell me in the comments, do you think the Fed should cut rates now or hold the line on inflation? I want to hear your take.